Hi, Juliana. Nice to speak with you again. Yes, I agree that the Delta variant is a big risk to markets, as is strong data, economic data, which will then signal to the markets that we are more likely than not to have a monetary policy response to tapering, and that will be a headwind for equity markets, no doubt about it. However, what we have seen when we look at what's coming through in the corporate numbers is that the corporate numbers and the corporate balance sheets remain unprecedentedly strong. That you've got record levels of cash on balance sheets that's driving share buybacks that's really accelerated at a rate that we haven't seen for a long, long time, if ever. And also you have north of $2.5 trillion in excess savings in the U.S. alone, providing really robust support for risky assets to run. You've got households and corporate balance sheets that are really the underpinnings of what I call the liquidity paradigm, which is what's bolstering all risk assets, but certainly equity market outlook. Now, do we think that the equity markets will rally double-digit again from here? It could be a possibility on the range of outcomes, but not likely to be. You're going to see continued equity market support because of the liquidity paradigm. Obviously not as much to run up as one would have predicted 6 months ago.
Now, Sunaina, you have a particular expertise with private equity, and private equity has been sitting on huge amounts of dry powder. Where and when do you expect private equity to deploy that dry powder in a meaningful way?
Yes, the dry powder in private equity is really at unprecedented levels. We're looking at $1.3 trillion sitting in private equity funds and assets globally, waiting to be deployed. Now, keep in mind that this capital comes with a clock. It has to be deployed in a 3 to 4 year investment period, which is typical for these funds. As you see volatility in equity markets, you're likely to see the valuations at which some of these private equity deals are done bounce around and certainly potentially trade down as well, which is a shopping spree opportunity for private equity investors who may go in and purchase these assets, take them private if they're publicly listed, which we've seen in Europe over the last 6 months, or even private equity to private equity fund transactions in the M&A market continue to pick up pace. This market will not be slowing down anytime soon with the absolute liquidity we see in the system going towards PE, but also the dry powder that needs to be deployed. Remember, the $1.3 trillion that I mentioned is just the equity powder. You add to that the leverage that's available for these buyout deals, and you're really looking at this huge wall of money waiting to be put to work.
Sunaina, I don't want to make this seem like we're gung-ho about the near-term future. It seems to me there are a few warning signs on the dashboard here, and not least the fact that retail participation seems to be very high at the moment. The commitment in terms of the flow into equities, a new record high in July, $15 billion here. Then you've got people like Tobias Levkovich and other professionals, he of course of Citi, suggesting that this should be troubling because this is a retail investor who maybe has never seen a significant market pullback ever in their trading career. Do we need to worry about the structure of the market at the moment?
Yes, the technical flows that are driving the market are very much driven by two participants. Apart from corporate balance sheets and institutional investors that are flush with cash, you do have the retail investor, especially in the U.S., that's sitting on savings that they've been putting to work in the markets. Can they get hurt? For sure. What are the risks to them getting hurt? A disorderly pullback of monetary policy and or the Delta variant slowing down or curtailing the economic recovery. Both of them are real risks here, and the range of possible outcomes is wider around the mean, around the bell curve is wider today than it ever has been before. And the caution to the winds of the retail investor is find hedges, find diversification. Don't just run after what you see in popular zeitgeist. Figure out how to shore up your portfolio because the range of outcomes is wider.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.